Hi, and welcome everyone. We've just got a few more people joining and then we'll get started. I wanted to welcome you all to Novia Global's Pulse webinar. This is the first one of 2024, which we're very excited about. We've got an exciting agenda for the rest of the year, so I'm hoping that you will join us for the other webinars that we'll have throughout the year. There'll be a range of DFMs, fund managers, technical experts, a variety of topics covered that hopefully will help you and educate you across the year. But I'm delighted to welcome today Nathan Sweeney, who is the CIO of Multi-Asset at Marlborough Fund Managers. And Nathan, it's got a really interesting topic to talk about today. It's been another eventful year last year, and 2024 is set to be even more eventful. We've got some upcoming elections in the UK and the US, and today Nathan is going to discuss how these events could have an impact on investments, and also how you as advisors can use this to your advantage with opportunities that may present themselves. The slides will run to about 30-35 minutes, and as always, we have the ability for you to channel any questions that you may have as Nathan runs through the presentation. You will see at the bottom of your screen a Q&A button. So it would be brilliant if you could, as the slides go through, think of any questions you may want to ask Nathan at the end of the session and submit those questions through the Q&A button. I will collate them all, and then we will have 10 minutes or so at the end just to run through them all. So without further ado, I'm going to hand you over to Nathan for today's presentation. Thank you.
Thank you, Linda, for the introduction, and thank you everybody for joining the call. So today's title is Navigating the 2024 Election Landscape. And the reason I wanted to talk about this is because 2024 is being dubbed the election year. And the reason behind that is because we have more elections this year globally than we've ever had in history. So the question is, will that impact markets, and in what way? So I'm going to delve into that topic in a bit of detail, but I'll also cover off a couple of other things that I think clients are interested in today. But before I go into any of that, I think it's important just to give you a little bit of a reminder of who we are and the team who manage the multi-asset solutions at Marlborough. So from my perspective, I think one of the singly most important things about the Marlborough Group is the fact that we're privately owned. And the reason I believe that that's important is because it means that we can focus on doing what we should be doing. And that's managing money for clients, engaging with clients, and providing good governance and oversight. And I think all too often what tends to happen is if you're in an organization which is listed, the focus tends to be on the share price and ultimately the shareholders. So sometimes you can find that those organizations make decisions which are short-term. So that privately owned piece, I believe personally, is quite important because it enables the investment team to focus on investing clients' assets. And ultimately, that's our role and our responsibility. So this is just a snapshot of the team at Marlborough Multi-Asset. And we have a collective experience of 125 years. And ultimately, experience is important, but it's not the only thing that's important. For me, I'm a big believer in diversity of thought. So that means that we want different people in the team to have different views, because that will help us to come to better decisions. And if you look across the team, you'll find that they have different qualifications and different backgrounds when it comes to that education. And that helps to have those diverse conversations. As an example, Ben has studied economics, where I have studied science. So we think about things slightly differently, but I think that that leads to better investment decisions. The last thing I'll say on team is that we have been running multi-asset solutions on the offshore side for almost 5 years. So the good news is we're coming up to that 5th year anniversary this May. And that's quite a pivotal point for a lot of investors because they like to see that track record. But I think it's equally important to highlight that we've actually been managing multi-asset solutions at Marlborough since the early 90s. So that's 30 years, in excess of 30 years of experience in managing multi-asset solutions. So there's quite a lot of experience within the team. So I think it's also quite important to that, because a lot of our clients who invest in the international product might not know that. So worth highlighting. But that's not what I'm here to talk about today. So today I wanted to really talk about elections, because I think that this year is going to be a big year for elections. We're going to see a lot of focus on these elections in the media. And we do live in a world where ultimately there's a lot of parties which have very conflicting views. So I've titled this Poles Apart, because you have those differing views, but also sometimes the polls which are used to predict what's going to happen are inaccurate. And that's due to the fact that we live in this world of misinformation or disinformation, which increases some of the risks around elections. So I'll start off with a couple of statistics. And this is just to set the scene and highlight how important this year is. So we actually have 76 countries globally voting this year. So it's quite a lot. That represents 4.2 billion people who have the ability to cast a vote this year. That's over 50% of the global population. So you can see the impact. And then actually, if you try to break that down into, GDP or monetary terms, it's 60% of the globe's growth potential. And why that's important is because ultimately those decisions, which are made by the new governments which come into power, can have an impact on relationships between countries. If I was to just give you a snippet of some of the countries which would be going to the polls this year, we've already had the election in Taiwan, which has happened. We have elections in India. We have European parliamentary elections. We have an election to be called in the UK. We have the US election. And the US election, in a way, will be a global election, because the outcome of that election will impact relationships with other countries. As an example, if we look at Taiwan, they have a fraught relationship with China, but those two countries will be waiting to see what the outcome of this election is to then decide on how they interact with each other going forward. Because as an example, if Donald Trump was to get in power, would he support Taiwan if there was any, I suppose, activity between China and Taiwan, military activity? So would you see support from China? And that will differ depending on the candidate. So that's quite important. The other thing to highlight is that, I did mention that the polls, or the election polls which come through, sometimes they don't give you the full picture. And sometimes what they predict doesn't actually happen. The reason behind that is because some people, they prefer not to state who they are voting for, or actually when they're asked, they will say something different for that reason. So therefore, we can't really rely on the polls. And therefore, it just means that increases the potential for volatility around these events, because the outcome might not be the outcome that's expected. So in the US today, the polls are predicting that Donald Trump will win the next election. The other thing to highlight is that between now and November, there's quite a long period of time, and a lot can happen. So these predictions do change also. If we think about what could happen, now let's say this poll is accurate and Donald Trump does win the next election, what would that mean? One thing which is likely to happen is you are likely to see the increase in tariffs on China and Chinese goods being exported to the US. So Donald Trump has already mentioned that he would like to put tariffs of up to 60% on goods coming from China. Now, it's unlikely that they're that high, that they're 60%, but it just shows you the intention. And we know that the last time he was in government, he did put tariffs in place. So that will affect the relationship between China and the US, and obviously the movement of goods. So ultimately, means that we are moving towards a world where we have de-globalization. So globalization just meaning that every country was open for business and lots of business happening between different countries, free movement of goods. We're now moving to a situation where governments are trying to protect their growth. And the way they do that is to say, well, if you're making cheap products in your country and you're distributing them to our country, and particularly if you're subsidizing those products, you're going to put business in our country out of business. A good example would be British steel, as an example, because Chinese steel was manufactured en masse and then also manufactured and being subsidized. So that has the potential to put other businesses globally out of business, and then you have market share, so then you can increase your price. So that's a strategy. So for a lot of governments, they're very aware of this and the risk of this, and what they want to do is to protect their own industry, which is why you should expect to see more tariffs coming from the US and then perhaps even the EU and globally if Donald Trump was to get into power. So that creates this deglobalization. So what we then move to is I would call it a 2 or even 3 world state. So you will have those countries who say, actually, when it comes to trade, I might want to side with China. And then you'll have other countries who say, when it comes to trade, I might want to side with the US. But it's not very clear cut about what countries will do. And I'll give you an example. So we know that there's closer ties today between Russia and China due to the events of the Ukraine war, because China has doubled the amount of oil that it buys from Russia. So it's very much helping to support Russia. And what we can see with Chile as an example, so you would expect that if countries were forced to decide on one versus the other because of this fractious relationship between the two, do I side with China or the US? Chile is a good example where we don't know if they would decide to side with the US or China because they're a big exporter of commodities and 50% of their copper is exported to China. So they have a stronger economic relationship. The other thing that you're likely to see is friend shoring. So this is the movement of jobs back towards the US. So this protectionist measure to protect industry. But because if you move those jobs back to the US, it ultimately costs companies more money. So what they do is they move back to countries which are more friendly or part of their bloc. So you're likely to see more jobs moving to, say, Mexico and Canada as a result of increase in tariffs. And I suppose one question is around, inflation. Could deglobalization be inflationary? But what we saw the last time around when we had tariffs being implemented by China is that they weren't inflationary. And the reason behind that is because countries or companies decided to, onshore to countries where the production of those products were cheaper. Like Vietnam would be a good example where you're seeing a lot more production happening in Vietnam, and China's losing that business. So you can see that, clearly this election it's not just a US election, it's more of a global election, and it's likely to have ramifications for both equity and bond markets in the short term. But the question is, we know that these events, these elections are likely to have an impact on markets in the very short term, but do they really have an impact on markets over time? And what we have here is we have the FTSE on the left and we have the S&P 500 on the right. And what we can see is the returns for both of those benchmarks under different governments. And if you were just to look at these charts, really you could just say, well, actually, I don't see any kind of real, consistency one way or the other to state that it looks better if party X is in power over party Y. So, if, as an example, in the UK, you had Labour in government, we're not seeing positive returns when Labour is in government across the board or negative. So there's nothing that I can take away from this and say, actually, there's a benefit to one over the other. Because the reason behind that is ultimately the things that tend to drive markets over the longer term are things like interest rates and, ultimately companies' development and research. And a lot of that tends to be outside of government control. So they can influence some things, like maybe they can change taxation. So you're likely to see tax cuts in the US, but what will that mean for bond markets? So there's ramifications of all of this. And the last thing I'll say on this point is that in the US election, over the last 3 election cycles, the 3 presidents who went into power, between them, they made 700 different election campaign promises. Now, we know that very few of those actually get passed into law. So the key takeaway is that there will be a lot of news about what these potential presidents are looking to do and the impact that that can have on markets. But ultimately, a lot of that won't come to fruition. And that's why, over the longer term, it tends not to really impact markets in any significant way. So from our perspective, we're less concerned about the short term. And from a tactical perspective, we will be looking at opportunities, and I'll talk about that towards the end of the presentation. But over the longer term, we know that there's less impact. So another big question is around inflation, because we've had a lot of inflation over the last 2 years. Now, the question is, where do we go from here? Do we see deflation or disinflation? So deflation just means that the price rises are not rising as quickly. And that's happening today. So if we look at inflation, last year we had prices going up by 10%. Now we have prices going up by 2 or 3% or 4%, depending on the region. So the rate of inflation is falling. So disinflation is, obviously that in action. So deflation is when we see prices falling, actually falling. And we're not seeing that today. So are they turning negative compared to last year? And the question is, will we see that happen? So what this slide shows you is it shows you inflation, but it also shows you average hourly earnings. And the reason I believe this slide is important today, and this is just looking at the US, but you can relate this to other regions too, is on the orange line, you can see inflation has fallen dramatically, and we expect it to continue to fall. But interestingly, wages are now higher than inflation. So that puts consumers in a much better position. They're in a better position because now they have money which can compensate for those higher prices. So what that does is psychologically, those consumers feel better off because the petrol prices have fallen, gas prices have fallen, food prices are falling, the price of that holiday's come down, and actually my wages are going up a bit more. So psychologically that helps. And that's one of the reasons why economic growth has been better than expected, because even for companies, their costs, their input costs to produce stuff are now falling, and that will help their earnings too. And this is one of the reasons why we haven't had the recession that people expected. So this will feed through into earnings this year. So I do think that that's quite an important point. But the big question for a lot of people is, will we see inflation reassert itself? Will inflation come back? And the reason people are asking that question is because we now have the potential for disruption to supply chains again. And what this chart shows you, it shows you that there's obviously a lot of trouble within the Middle East, and that's impacting trade through the Suez Canal. So 15% of all seaborne trade goes through the Suez Canal. And because of the attacks by Houthi rebels, those ships are deciding to go the long way around via the Horn of Africa. What that does is it adds 8 days onto that trading route to get back up to Europe, and $500,000 of fuel costs for those basically those ships then to travel that extra journey. That also means that cargo containers which are rented to ship those goods have gone up in price. Now, they're not going up in price because those containers are being demanded because people want more goods. they're going up in price because those containers have to be rented for a longer period of time. So you now need to rent it for an additional 8 days on the way there and an additional 8 days on the way back. So for me, what we have seen is there's a lot of talk about the increase in the cost of cargo shipping containers recently due to these events and the potential for that to impact inflation. But what you can really see on the chart on the right is even though those prices have gone up, they haven't gone up to the same extent that they did post-COVID, when you remember that those containers were scattered all across the globe because this port closed down during COVID, was operating at low efficiency, and therefore the containers were just, and that took a while to get back into shape, those supply chains. Plus, you had a lot of COVID revenge spending where people were going out and buying product en masse, buying stuff they wanted, stuff they couldn't get due to COVID. And therefore, there was huge demand for stuff post-COVID. And that led to a spike in shipping container costs, which helped to push up inflation. So because we don't see that demand for product today, and actually that demand is falling because prices are higher, and people are looking at those sticker prices, so the price of goods, and going, that still looks quite high. So people are changing their spending habits. So the question I would ask yourselves is, have you changed your spending habits? And a lot of people have. They're more sensitive to price today, and they're more aware of the price they're paying for goods today, because when inflation is high and it's in the media, it's in your mindset and you're thinking about it. So people are thinking about what they're spending the money on. But for me, I think the most important thing to focus on are things like the oil price and the gas price, because gas prices were one of the biggest contributors to inflation in Europe and the UK. We have now gone through the summer months, and gas prices have not risen near the level that they rose post-COVID, and when we had that supply chain disruption because of the war between Russia and Ukraine and all of those gas pipelines coming through Ukraine. So we haven't had that this winter, and we are through the winter period now. So ultimately, we are less concerned about the potential for the disruption in the Middle East to impact inflation today. The other thing I'll highlight just on the oil price is that what you tend to have is you need to see oil prices doubling for it to have a real impact on the economy to then create a recession as well. So if you look at the 12-month low for the oil price, it's about $67 a barrel. So we're currently close to, say, 80. You would need to see it up around 134 before it has a sizable impact on inflation and growth. So again, it's something we're watching because the events in the Middle East could erupt further. But today, as it stands, we're not concerned about inflation. What that means then is that ultimately central banks have the opportunity to cut interest rates. And the way I think about it, there's two parties in this. On one side, you have the central bank, and this is the orange bar. And this is the central bank saying where we think interest rates will be at the end of 2024. So this is the US central bank. But what central banks do is they try to make predictions on what they expect will happen. Now, those predictions might not come true because ultimately, as the data changes, they may not be able to do what they have intended to do. So what they intend to do today is to cut interest rates 3 times in the US this year. But on the other side, you have the market, and the market is saying, actually, we think the central bank is incorrect, and they're going to have to cut interest rates more than they have said. So why do we have this difference of opinions between the central bank and the market? The reason is because ultimately markets are trying to second guess what central banks are going to do. All the time, they're trying to second guess what they think those markets are going to do. And they believe when the central bank said, we're going to cut interest rates, when they said that at the back end of last year, they believe that the central banks were saying a recession is coming, and that's why we're saying we're going to cut interest rates. But that's not the case. So ultimately, central banks were just saying, we're going to cut interest rates because inflation is coming down. So this has created events in the bond market where you've seen those fluctuations in bonds. So bonds doing quite well towards the back end of last year, but then repricing doing less well at the start of this year as the market starts to come around to the realization that actually what central banks have said is likely to be that outcome. But that interrelationship is always at play. And from our perspective, it's trying to understand that interrelationship between the two to decide actually who's right. So hopefully that's given you a little bit of insight into both the political landscape and what we expect to happen on the inflation front. But what does that mean for positioning in portfolios? So here we have our tactical asset allocation. So what we do is every single month, we sit down as a team and we discuss how we think we should be positioned in portfolios. And this is the output from that meeting. So today, if we look at our positioning today, from an equity perspective, we're actually neutral. We think it's a good time to be in equities. And within equities, we're actually overweight one region. So we're overweight Japan, Japanese equities. The reason behind that is because Japanese equities are cheap today relative to a lot of other regions. And the government is putting in measures to try and increase growth in the economy and trying to encourage those companies to put in place incentives to unlock growth for shareholders. So there's a real push to get those companies to drive growth at a government level. And we're starting to see an improvement in company earnings coming through. And actually, Japan is one of the best performing regions this year. And it also did well last year. Now, one of the regions where we've got less conviction in is Europe, because European companies are going to suffer from the higher interest rates we have. And there is quite a strong relationship between Europe and China. And ultimately, if the Chinese economy improves, and we're seeing some signs of stabilization there, then that will benefit Europe. And at the moment, there's still a little bit of a way to go on that. So we can see stimulus coming out of China, but we're expecting more measures. And there's a lot being announced quite recently. On the fixed income side, we've talked about the fact that we think we're going to get interest rates. So it's not a question of if we get interest rate cuts this year, it's when they're going to happen. And from that perspective, we like government bonds. So we're overweight government bonds. But we do acknowledge that having interest rates higher over a period is likely to impact some companies, particularly those companies who have higher levels of debt. So this is high yield. So it's riskier bonds. So we're underweight riskier bonds. So that just gives you a little bit of a snapshot into our tactical asset allocation view. And we did get a question in from one of our clients, and they said, we produce a quarterly report, and they said, could you, in that report, put through some scenario analysis of what you expect to happen? So this is what we've done, and we've included that in our Q1 outlook for markets. So this is exactly it. And so what we're doing here is we're putting on our central case. So what we think is the most likely thing that will happen this year. And on either side of that, if things are better or worse than expected, what kind of probability would we ascribe to that? So our base case or our central case is that there's probably an 80% likelihood that we see a moderate slowdown in economic growth. So we have seen that to date. We have seen economic growth. If you saw the US figures that came out recently, economic growth slowed from 4.9% to just over 3%. But growth is still quite healthy. What that means is that we do expect inflation to fall to target. So we expect inflation to fall from the high levels today down towards that 2% target. What that does is it allows central banks to begin reducing interest rates. And we believe that's good for both equities and bonds, but it's probably less good for cash. So, cash has been paying 5% in some regions. And if interest rates begin to fall, then you're getting less interest from your cash, but bonds will be performing well in that environment, and so will equities. We do think that there's a likelihood, 15% likelihood, that maybe things are better than expected. The economy is stronger than we think. And in that environment, GDP stays steady. Inflation is likely to remain above target. And that means that interest rates are higher for longer. So for equities, it's not necessarily bad for equities, because if economic growth is steady, that means companies are still generating profits with economic growth steady. So we think it's an okay environment for equities. For bonds, you're being paid a higher level of income while you wait for those interest rate cuts. So it's okay for bonds too. And it's actually okay for cash then, because cash rates are higher because we don't get those interest rate cuts coming through as quickly as we expected. On the opposite side of that, so what is the worst case scenario? So ultimately, you could have a situation where we have economic growth slowing materially. And that's due to interest rates being higher, and then that impacting companies and then impacting growth. But that means that inflation will fall a lot quicker than expected and maybe even turn negative. And ultimately, what I'm saying here is that I think in the very short term, that would be bad for equities. But if I remember back to the pandemic, you saw equity markets falling quickly over a very short period, and then you had intervention. So I think if we did have that situation, we would have intervention. We would have central bank intervention, government intervention. And what that would mean is much quicker interest rate cuts. And that is good for equities. So in that environment, you should expect to see quite a quick reversal, because governments would step in and cut interest rates quite rapidly. So I do think that over the very short term would be bad for equities, but actually it would be quite good for equities. And again, good for bonds because you're getting that cut in interest rates, and bad for cash ultimately, because bonds would be performing a lot better and the interest on offer on cash would reduce. Okay, so that's given you a quick update today on what we expect to happen on the election front. We think that elections will bring volatility this year. It's likely to have different impacts on different asset classes in different regions. So from our perspective, we have been doing a lot of work on what we think that means, and how that impacts how we will position as we move closer to those events. Because the things that people think might play out might not actually. And there's a couple of scenarios that we've been looking at on that front. On the inflation front, we do think that inflation will continue to come down, which opens the door for central banks to cut interest rates. And as we've said, that's quite good for markets. That would be good for equities and good for bonds, but less good for cash. And that's our central case. And you're starting to see that play out. We've had quite a good start for equities this year. Central banks have a lot of meetings this week, and you should expect to see more signaling on the timing of those interest rate cuts. So it's not likely to be March, it's likely to be the summer, but we do expect those to happen. So hopefully you found that insightful. It's a short update today, but I'm really happy to take questions, because I'm sure there's plenty of questions about what's happening in markets.
Thank you very much, as always, Nathan. That was really, really interesting. A couple of things that I pulled out of it personally were, as a politics graduate, I was quite excited that 50% of the global population can vote this year. That was a fact. And I'm also going to use the term COVID revenge spending next time the Amazon. Thank you so much. That was really interesting. And exactly as you said, there's been quite a few questions. So I'm just going to go through a few of them. Are there any particular indicators or signals that you monitor to stay ahead of market movement amid the electoral global uncertainties that you've mentioned throughout the presentation?
Yeah, so the tactical asset allocation document, which we put together, as part of that, we actually put together a thing called a thermometer pack. And we use that to try and give us lots of indicators on what's happening in different regions across the globe. So one thing that's worth looking at are things which are called high frequency indicators. So the problem today is that a lot of the data people look at are backward looking. So you might wait for 1 month, 2 months, 3 months before you get a data print, which is telling you about something which has happened a couple of months ago. But you can get indicators which are more frequent, which are giving you an idea of what's happening today in current levels. A good example of that would be there are indexes which follow people's sentiment or view on social media platforms like Twitter. Because that's actually how people are feeling today. So how are people feeling about inflation today? How are people feeling about inflation today? And there's so much data on those platforms that can help give you a little bit of insight into what's happening. So when we're assessing our view, we do take some of those indicators into consideration. Another thing I'd say is that a lot of people, because we've been doing research as well, so we try to get research from different viewpoints. And I was actually reading something last night on the US election. And so everybody is of the view that we should be investing in long duration today. But ultimately, if Donald Trump does get into power, he will implement lots of tax cuts. And that means more government spending. So what does that mean for the financing for the government? And what does that mean for longer duration bonds? So you're likely to see a steepening in the yield curve because they're going to increase their spending. So everybody has this perception, I should just buy long duration bonds because interest rates are going to fall. But there are other things to consider. So I think as we get to that, we're going to have to really look at the positioning we have within fixed income. So today we're neutrally positioned in bonds, but we have some short and long. So then the question will be actually, do we want less of this as we move towards that, depending on the outcome of that? So there is a lot to think about, and we do look at these things quite frequently, and we do get a lot of data to help with that. So we subscribe to Goldman Sachs Research and other providers, which just gives us some of that high frequency stuff.
Thank you for that. A couple of other questions. So this is not directly election related, but outside of the US and the UK, are there any specific regions or events, such as there's lots of talk about World War III at the minute, etc., that investors should pay particular close attention to this year?
Yes, I think geopolitics are always there. I was looking at a map of global conflict. There's conflict in a lot of regions globally. So we read about the main regions where we have conflict today. So Russia, Ukraine, and it's in the media, and whether that is China, Taiwan in the future. But ultimately, there's conflict in regions everywhere, Kosovo, Serbia, etc. There's a big map. I do think that we live in a more fractured world as we move towards deglobalization. But ultimately, governments will have to ask the question, is that worth it? Is it good to foster good relationships to try and keep things like cost and inflation down for the wider populace? So I do think that's something which a lot of people will have to ask as we move towards the year. We don't think we're moving towards a situation where we have World War III. We are moving towards a situation where we have economic warfare. And so the warfare we have today is all about superiority in technology. So I want to have access to those microchips in Taiwan because ultimately they are used in 60% of sophisticated product globally, and they account for a huge proportion of global growth. So that's a quite important company. So Taiwanese Semiconductors, and if that company was offline, that would impact all of our lives in a big, big way, and would impact global growth in a big, big way because it's used in computers, supercomputers, AI, data centers, cars. So I don't think that we get to a regional war, but I do see lots of opportunities because that stuff is always ever present. But I do think there'll be a lot of opportunities in small cap, as an example, because small cap is really oversold, very sensitive to interest rate cuts. And a lot of those companies are now in a better operating position because they've been cutting costs to manage in a difficult period. So when you get those interest rate cuts, they get a thing called operational leverage. So their profits tend to go up quite strongly on the other side. So that's an area we're doing a lot of work on. So, and another thing I'd also say is China, forgetting about the geopolitics, there's a lot of opportunity there too, because that market is sold off for almost 4 years. So Chinese equities are down about 60%, really cheap. And that government is now really putting in measures to address the issues they have in the property market, trying to build confidence in the equity market. So that's something which a lot of investors might overlook because of the geopolitical tensions. and therefore miss out on. But from our perspective, we're always trying to look through to the investment opportunity.
Okay, brilliant. Thank you so much for that. So we've got probably two more questions, time for two more. What is your view on the US financial sector if the Fed decrease interest rates by at least 1%?
Yeah, so look, if we get a cut in interest rates, it'll help mortgages on one side. It'll help the loan book as well. Those companies are obviously today earning a little bit more interest from cash on account because it's at a higher level. So that's helping. I do think for financials generally, they have a structural issue. They have a structural issue because of disruption. So we all know there's a lot more new companies today trying to get into that space. And even think about the advisor world. There's a lot of technology coming into our space and trying to offer different products and different platforms. And it's easier for companies to set up because the technology is more sophisticated. So there's less cost in doing so. So my view is that we'll see a lot more disruption within the financial sector. And cryptocurrency is one example of that. It's trying to remove almost the middleman, which are the financial institutions. That's the whole concept behind digital currencies. So I do think that it will be good for their earnings in the short term because they'll get a boost from certain segments. But I think longer term, financials have struggled because I think structurally there's a bit of an issue there.
Yeah, brilliant. Okay, thank you. And then just final question. What can the next US president, whoever that may be, do about increasing the US budget deficit, which is becoming an increasing threat?
Yeah, so what you tend to find is, so first point, there's only two countries in the world who have a debt ceiling in place. So it's the US and Denmark. So we never hear about Denmark because they've set their ceiling so high that it's not an issue. The problem for the US is that they've set it to a level where they have to keep setting it again and again. So going back to parliament or government to negotiate, can we move it higher? So it's in the media every single couple of months. And therefore, there's a lot of focus on it. Now, if we were to create a league table of countries who you shouldn't lend to because they have a bad economy, they've got a lot of debt, they're borrowing a lot, their cost of financing is high, the US doesn't feature in that league table. It's down the bottom of it. Now, what you should really be focused on is economic growth. If you're a country and you've got really good economic growth and you're taking on debt, it's less of an issue because you can grow to service that debt. So if you just take on the face of it, some of the best companies in the world are in the US. Some of the best technology in the world is in the US. That helps to drive growth. If you look at growth in the US, it's still quite positive. So taking on additional debt hasn't caused the bond market to sell off in the US because they're concerned about their ability to pay. So if you look at bond yields today, they're very much in line with interest rates. If they were higher, that would be reflecting the fact that people are concerned about their ability to repay, but they're not because it's a strong economy. But there will be a point when that changes. But that is, I would say that in a way, that's history because every empire has that problem at a point in time. But I don't see that as being an event today or in the near term because I don't see any threat to that dominance. So you can see clearly China has got real problems and India, while growing, has a long way to grow. So Ray Dalio, great hedge fund guy, he's been talking about this, but they're very, very long cycles. So again, it's not something we're overly concerned about. We do think that debt will increase under a Trump presidency because he's likely to spend tax cuts, but that will lead to higher growth.
Yeah, brilliant. Okay, thank you so much for that. And thank you everyone for your input and your questions as well. Obviously, if you do have any others, you'll have Nathan's details that you can drop him a note. I'm sure I'll be happily answer any further queries you might have from this presentation. All the sessions are recorded, so this session is recorded and everyone that's registered will get a copy of this, so you'll be able to listen back or forward on to your colleagues. Our next webinar will be with Stephen Yu of Blue Whale Capital, and that will be held on the 28th of February. The details and the invite for that will be going out in our next Pulse newsletter, which will be sent out next week. So all that remains is for me to thank you for attending and registering. We really appreciate your support. We hope to see you in future ones throughout the year. And thank you very much, as always, Nathan. Super interesting, super topical, and as engaging as ever. So thank you so much for your time, everyone. And we look forward to you welcoming on the next Pulse webinar. Thank you.
Okay, thank you for having me.